Hello everyone, I'm Ted Oakley. I'm managing partner at Oxbow Advisors, and we have an interesting subject today that we've never discussed, but I know all of you out there that have any substantial net worth or obviously have some life insurance or maybe a lot of life insurance. And one of the things I've noticed when my guest today has brought to my attention is that there's a lot of changes in this business, especially with lower interest rates and a lot of things. But I'm glad to have a person I've known for a long time, for 4 decades actually, out of Dallas, Texas, Todd Healy, who is the founding partner of C3's Financial Partners and someone I know to be knowledgeable of the business. And what I'd asked Todd to do was talk a little bit about some of the subjects that we've had come up with people. Not for us, we're not in the insurance business, but for people that have told us that they had problems with. And Todd, welcome.
Thank you, Ted. Glad to be here. Appreciate the opportunity.
Yeah. Let me kick it off with, there's been some changes in the industry that people probably with policies never think about, but you might give us an idea of some of those.
Yeah, there have been a tremendous number of changes. To begin with, the insurance companies, there are probably a third of the companies doing business today that were when I started in the business in the late 70s. In addition, a lot of those carriers are getting out of the individual life insurance business. They're folding up the tent, so to speak. They're not writing new coverage. We got a memo yesterday for another company that's going out of the individual business in the corporate-owned life insurance arena. Carriers are changing their product provisions. MetLife, for example, used to have a tremendous number of policies in the permanent side of their company that you could convert to or buy. About 2 years ago, they announced they're getting rid of all those policies that are death benefit driven and focusing on policies that are cash value to supplement retirement. Our business is not driven on cash accumulation. That's your business. Our business is driven on death benefit protection. So that's some of the changes. In addition, products have changed dramatically. We've seen carriers, when I came in the business, there were 2 types of products. There was permanent insurance and there was term insurance. And that was basically it. There were individual coverages, no joint policies. Now we have 7 different types of policies, and each one has probably 30 variables that can be attached to it, different riders and whatnot. We have second to die insurance where people buy it for estate taxes because taxes are typically deferred. And we also have second to die policies that are being used for buy-sell arrangements. So tremendous number of changes. We at one point we had fixed premiums. You bought a whole life policy, the premium was fixed, it was established. Now the policies are determined by variable interest rates, basically by the market, so they can fluctuate, and they certainly have over time.
Let me ask you this. A lot of people that have a lot of net worth have policies that have been around a long time. They just haven't taken a look at them. But a question for you or your experience, how long do you think people have had, on average, large life insurance policies that they probably just put back and they just haven't looked at, like 5 years, 10 years, some longer?
At least 5 years. Most people think in terms of the premium they pay, they think in terms of the cash value, they don't think in terms of the death benefit. So that's one of the reasons we call it the largest unmanaged asset in a client's portfolio. They just don't look at it. Recently I did a video entitled, "My Mother-in-Law is 99, that's the good news. The bad news is her policy died when she was 95 because the insurance company, when she bought her policy from me, insurance companies figured nobody lived beyond 95. So that's another reason to go back and visit them. You can now buy policies out to 120 and even beyond, but a lot of people don't realize they have policies that are going to expire probably before they do.
You might answer this for me. Now, I know what this means, in-force ledger, but you might explain to the audience that if they haven't had that done or some sort of review, it may be something that they need to keep in mind, particularly with all the changes.
Yeah, we've got a slide we'll show in a second that shows the impact of the lower interest rates, but clearly anybody who's bought a policy more than 5 years old, interest rates have dropped dramatically, and an in-force ledger just shows them what the impact of those lower rates would be if they tried to make up for the lower interest rates. If they went in funding it at 5.5% or 4% and now it's 3%, an in-force ledger just shows them the impact of that lower interest rate. It also can show them how they can adjust the premium back to account for those lower rates.
Because it seems to us, at least, that most people don't do they very seldom do a review and take a look at it. I'm not sure they know.
No, we think most people are satisfied. They bought the insurance policy. They don't realize the impact of lower interest rates. We talked about 1/3 of the companies are around, probably 1/3 of the original agents that sold the policies are around, if that many. So there's no agent calling on them, asking them to review. The insurance companies aren't reaching out and saying, hey, you really need to review this policy because rates have dropped. So that's why we refer to it as one of the largest unmanaged assets.
Do you find that the businesses are aware, or they've forgotten they had policies on various key people, or what's going on in that arena?
That's a huge issue because unless it's a permanent policy, it's not showing up on the company books anywhere. It's not on the balance sheet. They're not reflecting it. We had a situation where the banker referred us into a customer of theirs that had gone bankrupt, and the owners of the bankrupt business had purchased the business, and part of that purchase included 2 policies on prior owners, and nobody had thought to look at those. Those turned out to be the only significant asset the company had. But mergers and acquisitions, sales, that life insurance is typically not taken into consideration, and it could be a very, very valuable asset, particularly if the owner or the original insured lost health or had it change in their health status or underwriting status. Could be a very valuable policy to somebody.
And I think a lot of businesses, when you've been in business 20 or 30 years, you've basically forgotten what you did 20 years ago in this respect, especially if it's not on the balance sheet, like you say. Something that all you business owners out there ought to keep in mind at this point, particularly now. And Todd, this next slide we've got that you gave us, and I think this is one of the most important things that people need to think about today, and you're probably not thinking about it, but this change in interest rate, which has affected us in the bond markets, affected investors in the stock market, but it's really affected the insurance policies. You might talk about this slide.
Well, this is an actual client who was 33 when he bought the policy in 2012, so 9 years ago. And he bought a $10 million policy. The premium at that point, the interest rate was 5.2%. That required a premium of $55,000 a year. The interest rate dropped 4 years later to 4.6%. In order to keep the policy going at that interest rate, he would have to increase his premium to $62,000, which he did not do. 1 year later, it dropped almost 100 basis points to 4.35, and it would have required a premium of $69,000 to keep it going. 2020, the premium interest rate dropped to 3.4%, which would have required a premium of $93,000, almost doubling what the premium was when he started out. And these are in-force ledgers that we went back and reviews we did with him every year, and he still opted to keep the original premium. So now, in order to make the policy do what he originally planned for it to do, the premium is going to have to be more than double what he anticipated.
Todd, one of the things, as you know, we work primarily with business owners that haven't sold their company. They may sell the company at some point in time, but most of their money is in the company. They have some on the outside, and we find that what they should have done or have done is really purchase insurance for a liquidity event in case something happens to those owners. And are you seeing that most of those people actually understand what they're doing? Are they doing the right things?
No, honestly, a lot of times they're buying insurance in the business because the bank's requiring it for collateralizing a loan. They've got key man insurance, maybe if there's more than one owner of the company. But again, they tend to forget about it. They tend to ignore it. They have very little liquidity inside the business or outside of the business. And when they die, if the policy is owned by the business and they're still active in the business, the value of the policy will be includable in their estate for estate tax purposes. So it's really could be a double whammy. On the other side of things, their health could change and they forget about the policy and the policy lapses, and it could be something they could have taken with them during the sale or merger of the company.
And let's talk about that. You have a slide here about if you get in position where you sold the company or the coverage is not needed. Talk about those things.
Yeah, there's really about 3 areas where the insurance may no longer be needed. Number one, if they sold the business, their policy is not needed for buy-sell or key man purposes. The second thing would be estate tax exemption has gone up so much. When you and I started, the exemption was about $120,000 per individual. Now it's 11.7 million per individual. So a lot of people who bought insurance when the estate tax exemption or the amount they could pass tax-free was much lower don't need the coverage. The other thing we find is some people can't afford it anymore. We had an oil and gas family in West Texas, had a substantial amount of insurance they'd purchased from us over the past 25, 30 years. And the insured had gotten in poor health, but they couldn't pay the premiums with oil and gas prices doing what they did last year. So what we did, we were able to sell a couple of the policies to maintain the premiums on the third policy. And that turned out to be very significant for them. The other situation that happens if it's a key man policy and the individual is no longer a key man, the business may not want to keep the policy. We had a client call and ask us about a key man policy they were just going to let go. It was a 10-year term policy. The insured was no longer a key employee, and they were just going to let the term policy expire. We were able to go to the market, and we sold that policy to the independent market for about 10 times the annual premium. They got all their premiums back plus enough to start a new policy on the new key man.
That's interesting, even though it was a term policy.
Yeah, absolutely. People don't think term policies have value. They have a tremendous amount of value if there's been a change in health, for sure.
That's interesting. So what happens is, if I hear you correctly, is that there's a lot of businesses that are not really, they probably have more value in that than they think they have, and they just haven't taken a look at it.
Yeah, individuals as well, Ted. You know, a business may have a policy that's a permanent policy they're carrying on the books for the cash surrender value. So their options are to let the policy lapse. You know, my father-in-law had a contract that was similar to that. He developed terminal lung cancer, as you know, and we just said there's no point in paying any more premiums. So there was enough value in the policy to keep it going with no more premiums going in, because if he had continued to pay premiums, it would not have increased his death benefit. So he just, you know, we let the policy just kind of pay its own way. The second thing that can be done if the policy is no longer needed or they can't afford it is just to basically sell it back to the insurance company. When you surrender a policy for its cash value, that's all you're doing is you're basically selling it back to the carrier. And we prefer the third option, which is to go to the open market and get bids for the contract, see what it's actually worth in the open market. And typically it's been 2 to 3 times what the cash value is.
Because a lot of times, a lot of our business owners have had 2 or 3 huge liquidity events. Mm-hmm. And so the insurance from a liquidity standpoint is not that much. And I don't think that a lot of them are aware that they can take that back to the market and just go ahead and sell it.
90% of the people who have policies have no idea that exists. This business owner that had the term policy had no idea this market existed. We work with major law firms that had no idea this market even existed. We had one client that a law firm called us about that he was in his 90s. He had a policy that was about a $5 million contract. He was not going to pay any more premiums. It wasn't an economic deal. It was an emotional deal. And he was going to let the policy go. It literally had $18,000 of value in it. And we sold it for over $1.2 million in the open market.
Interesting. That's interesting. I hope that people out there can think about that when you start taking a look at things. Let me ask you on your next slide, we talked about this before, there's been a tremendous amount of merger and people getting out of the life business. You know, when interest rates get so low and the cap rates get so low on real estate, you know, these companies have a hard time making money. Yeah. And so I see what they're doing. You know, they're merging or they're getting out of the life business. What does somebody do? They get something that says, hey, we're out of the business. What next?
Well, they're not out of the existing business. They're out of writing new policies. That's the first thing to keep in mind. So they can't shirk their responsibility to the existing policyholders. But if the existing policyholders are insurable, if they've got good health, it's at least worth taking a look at moving to another carrier that's more substantial and more committed to the marketplace. If they're not healthy, then they just need to find out what their options are with the existing carrier. And again, going back to the idea of maybe minimizing premium instead of continuing to fund it at the original level.
So let me ask you one last thing on the last slide that you've given us here. We couldn't let this one get past, and that is everybody obviously have an idea, an interest in this, but talk about the new tax laws changes or what you think's coming from that.
Well, if Congress doesn't do anything at the end of 2025, the exemption basically cuts in half. The amount you can pass tax-free will drop from 11.7 to about 5 million, which is still very substantial. And it only impacts about 1/100th of the population. So it's not a tax that impacts a lot of people, which is one reason it's difficult to fight it. But what they're proposing is, number one, reducing the amount you can pass tax-free, and just as importantly, maybe more importantly to your viewers, is the brackets going up. Right now, the top bracket's 40%. When you and I came into business, the top bracket was 60% with that exemption of 120,000. We could see that going back up. There are so many things they can do. Probably one of the most significant impacts would be if they eliminate step up in basis. If they say the stock they bought in 1990 does not take a step up basis to when they die in the year 2030, then it's really a double taxation. They're going to pay tax of their estate based on the fair market value of the stock, and in addition, they're going to pay capital gains tax. And the bill that's currently being proposed says they pay that tax when they die, not when the stock is sold. So that's why I say it's effectively a double tax.
That's interesting. I think we'll have to see what comes out of that. For everyone out there watching, you've seen a few of the flyers at the bottom of our interview, and there's another one here now. And I would say that, at C3, they have so many people there that can look at various things. We've had a number of people across the country that we've had reviewed just to see where they were, and they've done such a great job at that, Todd. And I want to thank you today for being on with us. I hope that everyone, if they have a question or they have something of interest, they can get in touch. But we appreciate you being on, and till we see you next time, thanks a lot.
Thank you, Ted. My pleasure. Stay safe.
All right.